Today is the 6th of June 2022. My name is David Hickson, and in today's market update we're going to be covering a few instruments, the S&P 500, the NASDAQ, gold and also Bitcoin. Before we take a look at the markets, I must ask you to please make sure that you have read and understood these disclaimers. So let's get started, as we pretty much always do, with the S&P 500. This is the analysis we've been looking at for many months. We have, of course, the prominent trough in March of 2020, and in my opinion, the 18-month cycle trough most probably occurred here at the beginning of October. In last week's market update, I discussed the magnitude of the trough that we have just experienced in the middle of May, or about the third week of May. I discussed the possibility of that being an 80-day cycle trough, which was what we originally expected, or perhaps a 20-week cycle trough, or maybe even a 40-week cycle trough. In my opinion, it was most probably a 40-week cycle trough that formed there in the third week of May. As you can see, I have had to influence the analysis slightly in order to get the 40-week cycle trough over there, which has already been confirmed in the analysis by Sentient Trader. Well, when I say confirmed, it has been tentatively confirmed. As you can see, those are hollow diamonds, which means that Sentient Trader considers it very likely that that is a trough of the 40-week cycle, but it will only actually confirm that and fill in the diamonds as it has done with this 18-month cycle trough over here once we can see a bit more of the price action. The interesting thing about the analysis here is that I have pinned the 20-week cycle trough over here to its position in January. And the reason that I did that was because Sentient Trader was inclined to position that 20-week cycle trough over here on the 24th of February. And if you go back and take a look at the market update videos that I recorded at that time, you will know that this cluster of three troughs provided a bit of a puzzle in terms of the placement of that 20-week cycle trough. Interestingly, this low price, the sort of pin bar that jumps down over there, is on the 24th of February, which, if memory serves me correctly, was the date that the Ukraine was invaded. And so that jump down in price and then straight back up again was in fact what Hurst described as fundamental interaction, which is when news events from around the world influence the markets. And you probably know by now, if you've watched many of these market update videos, that I believe that news events don't in fact turn markets, but they do certainly cause a lot of extra volatility. And that volatility we saw on the 24th of February was probably not the formation of a 20-week cycle trough, but was simply fundamental interaction. And so the better position for the 20-week cycle trough, in my opinion, is in January. Interestingly, Sentient Trader does actually account for the idea of fundamental interaction, and it will sometimes position its trough off the actual price low, but in this case it didn't, probably because of these two troughs here, which brought price down, of course, into the 80-day cycle trough. Nevertheless, the 40-week cycle trough is, in my opinion, the trough that formed over here in the middle of May. And so what we are seeing now is price bouncing out of the 40-week cycle trough. This gives us, if we move this chart over a little bit, this gives us very nice and neat nests of lows to indicate what we should expect in the near future in terms of cycle troughs. We have the 80-day cycle trough now in July and the 20-week cycle trough over here in September. One of the great benefits of a Hurst cycles analysis is because of the harmonic relationship or the harmonic ratio between the wavelengths of the cycles. We can anticipate that a trough is going to form in July, as we have done for several months, I believe, and we were anticipating a deeper trough. In other words, we were looking at the 40-week cycle trough probably occurring in July. But moving the 40-week cycle trough over to May doesn't change the fact that we do still expect a trough to form in July. That's one of the really interesting things about the fact that we have the harmonic ratio between the wavelengths. So even when the magnitude of a trough shifts, we nevertheless still expect a trough, but it might be of a different magnitude at the time that we were expecting the trough, if that makes sense. So let's just have a look at some of the detail here. As you can see, and let me move this chart back again, if we count the number of bars from this 18-month cycle trough to the 40-week cycle trough, you can see there were 231 days or 33 weeks. So it was a short 40-week cycle, which some people might interpret to mean that we still need to wait another 40 days or so. The average length of a 40-week cycle is 272 days, as discovered by Hurst 50 years ago, but we have to allow for the principle of variation, and so it is quite possible that this 40-week cycle trough has occurred early. And more important than the exact wavelength at which the cycle trough occurs is the full analysis process. In other words, the identification of these shorter cycles. Performing a Hurst cycles analysis is like solving a complex puzzle. You are identifying the trough positions of the shorter and shorter cycles, and as you identify the shorter and shorter cycles, so you solve the puzzle, and that is more important than the exact wavelength at which a trough forms. Certainly using the analysis process presented by Hurst in his Cycles course, which he published in 1970. So the 40-week cycle trough has probably formed. As I mentioned in last week's market update video, what we are going to be doing now is we are going to be watching as price is influenced by the cycles to monitor the state of the market. And by the state of the market, I mean how bullish is this market, or is it actually not really very bullish, and is it in fact still a bearish market? And so the way in which we do that is we watch the way in which the cycle shapes are formed in the market. And I discussed last week that we are going to watch the first 20-day cycle, because if we zoom in here, you can see this nest of lows here at the foot of the chart for the 20-day cycle. There it is. That's the nest of lows for the 20-day cycle, and so we're going to watch that first 20-day cycle. Now, I have displayed the FLD, the future line of demarcation, and you probably know that we track a sequence of interactions between price and the FLD. That helps us not only to refine our analysis and also our understanding of what is happening in the markets, but it also enables us to make trading decisions. And so following a trough of at least 80-day magnitude, and this was certainly of at least 80-day magnitude in my opinion, we get price crossing above the FLD. We label that an A category interaction. We then expect price to reach up and achieve its target. And indeed, price did achieve that target. As you can see, I believe the target was at a level of about 4,200 or a little below 4,200. What we expect after that is for price to come back to the FLD and find support at the level of the FLD at about the time that the 20-day cycle trough is forming. I've already indicated the nest of lows over there. And so we are expecting a 20-day cycle trough. Looking at the price action, it is likely that the 20-day cycle trough actually formed a few days early on Wednesday of last week. Although in some markets, I think in the NASDAQ, Thursday had a slightly lower price, so it is possible that Thursday was the 20-day cycle trough. The important thing is that we are looking for the FLD to provide support at the level of the 20-day FLD. Certainly in pre-market trading, I'm recording this video before the markets open in the US on Monday, and in early morning trading in Europe, overnight trading in the US, you can see we've already seen a little bit of bullish price action, probably not very meaningful yet, but it would seem that price is finding support at this level. That is what we would expect following a trough of 40-week magnitude, or indeed of only 80-day magnitude. We would expect that. But we're looking for this market to reveal its bullishness. If it slips fairly far below the 20-day FLD and forms a lower trough, then we would begin to question the bullishness of the market. At the moment, it's looking fairly balanced. It achieved its target fairly accurately, as you can see over here, and it is finding fairly accurate support at the level of the 20-day FLD. And so it certainly looks as if though this market is fairly balanced, it's fairly good, and as expected, fairly bullish market. In last week's video, I showed the ES futures price, and this is receiving live data from Yahoo Finance, and so this is slightly more up to date. The analysis is ever so slightly different, but not very different. As you can see here, we have the 40-week cycle trough over here. Here is our A category interaction where price crossed above the FLD, achieved its target fairly accurately, and it is now in the process of finding support at the 20-day FLD. The reason I'm showing you this workspace is because we dipped into the intraday realm last week, and I thought I would do that again. It turned out to be a popular thing to do. And so this is a 4-hour chart, as you can see in the watermark over here, for the ES futures contract. And here is the 20-day FLD. Now, there's an interesting thing to be pointed out when it comes to looking at an FLD for the 20-day cycle on the 4-hour or even the 1-hour or perhaps even the 15-minute chart. That is that the FLD is calculated on the basis of the recent analysis of the cycle in question, of course. It is simply median price displaced to the right by half the cycle wavelength. But there is a small, subtle detail. Hurst suggested that we add 1 bar onto half the recent wavelength, which when you're looking at a daily chart means that you're actually shifting the FLD by an entire day to the right. Now, on the 4-hour chart, because we're following strictly according to the letter of what Hurst defined, we are shifting the median price by half of the average wavelength. We are also moving it over 1 bar, but that's only 4 hours. And so whenever you're looking at an FLD on an intraday chart, or perhaps if you're looking at an 18-month FLD on a daily chart, you need to consider the relationship between the wavelength of the cycle and the time frame of the chart that you're looking at. Because what tends to happen is these FLDs should probably, strictly speaking, be displaced a little further to the right. So, for instance, this FLD, if it should be displaced by 1 day to the right, would in fact be over here, as you can see. So price is actually very accurately finding support at the level of that FLD. And before you ask why we don't just do that to all of the FLDs, it's because in this particular situation it works really well. But there are also situations where it doesn't work well, and so there is no clear argument either way as to whether we should add 1 day onto the displacement of the median price for the FLD. Let's delve a little further intraday and see what these charts have to show us. Here is the 1-hour chart, and there again is our 20-day FLD. And again, you can see that the FLD itself is entering a bit of a sort of an up and down phase, no particular direction. So certainly price is at about the level of the FLD. Again, we could argue whether the FLD should be displaced further to the right. I don't think it's really worth getting into too much of a discussion about that. Here is the 15-minute chart, just to take it to its absurd extreme. But the interesting thing about when you look at the shorter and shorter time frames is you can start, of course, looking at shorter and shorter FLDs. This is a 1-day FLD, and this 1-day FLD was very cleanly crossed, as I think you can see in early morning trading over here. The FLD was crossed, indicating that we have a 1-day cycle trough behind us. There it is. Here, as a matter of interest, is the circle and the whiskers for the 20-day cycle. So you can see we are certainly very well positioned for a 20-day cycle trough to form. This crossing of the 1-day FLD generates a target to the upside. It's higher than we can see on this chart. And if I display the 20-day FLD on here as well, you can see here is the 20-day FLD. It's not really very meaningful on a 15-minute chart, but the point is that price is now in the process, it would seem, of finding support at the level of the 20-day FLD, which is what we expect it to do as the 20-day cycle trough forms. Switching back to the chart we were looking at earlier, this is the composite model line, which is of course the line that is composed as a result of the analysis that has been performed in the chart. It is taking all of the cycle information and it is recombining it, and it is producing this line, which indicates what would be expected to happen if the analysis is correct, of course, and if the cycles continue to beat with the same rhythm and the same amplitude that they have been beating with recently. The important thing here, of course, is that we're looking at a move up into a peak, which we would expect in about the third week of June, I think that is. Here is our July trough that I have already mentioned. There's our very neat nest of lows. So that's a trough that is very likely to form at about that time. Then, of course, we will get our second peak over here, and then a move down into the 20-week cycle trough over here in September. The important thing about this is that the composite model line is very good at indicating the structure of the market. It positions signposts that we can look out for in terms of when troughs are likely to form. Remember, this is a trough-based analysis. We are considering the fact that the cycles that influence this market are synchronized at their troughs. There is no peak-based analysis on this chart, as you can see, and so we're only considering the trough-based analysis. The result is that the troughs tend to be fairly accurately positioned in terms of their timing. The peaks will vary depending on the bullishness of the market. We are expecting an M shape, a fairly bullish M shape, to play out if this analysis is correct. But then, of course, we're looking at the market turning bearish for the next 20-week cycle to bring us down into an 18-month cycle trough expected early next year. Let's compare this to what we are led to believe is going to happen in the NASDAQ. So here is the NASDAQ, and as I've discussed in previous videos, the difference with the NASDAQ is that we have a lower trough in December of 2018, which is possibly the 54-month cycle trough, which means that we are now in our third 18-month cycle, which would explain the increased bearishness of this cycle, because of course we are moving down into this 54-month cycle trough early next year. Whether that is going to be a 54-month cycle trough or whether it is only going to be an 18-month cycle trough doesn't bother me terribly at the moment, because I tend to be trading with a shorter time frame in mind. I know that certainly I'm expecting a trough of at least 18-month magnitude early next year. But the bearishness that we have experienced since October with this bearish shaped cycle that I've discussed in previous videos is certainly explained by the fact that we are in our third 18-month cycle. So let's zoom in here and take a look at the formation of the 40-week cycle trough, which I discussed also in last week's video, and we can display the FLD. And if we zoom all the way in, again you can see that as the 20-day cycle trough is expected to form in the markets, and there is that slightly lower price on Thursday of last week, so it is quite possible that that 20-day cycle trough formed on Thursday of last week. But here is the 20-day FLD providing support for price, and so we're going to be watching that very carefully. An FLD provides a testing time, if you like. We're watching how price interacts with the FLD. If our premise is correct, if this analysis is correct, then the 20-day FLD will provide approximate support. And so it gives us a very good level to test our hypothesis in terms of the analysis. If, of course, price crosses dramatically down below the 20-day FLD, then we will have to reconsider the analysis that we are looking at. But now if we zoom out a little bit and display the composite model line here on the NASDAQ, there's an interesting comparison to be made with the S&P 500, which I thought was worth pointing out. Again, here we have our nests of lows for the 80-day cycle trough that is expected to form in July, as is the case in the S&P 500, and in fact in most stock markets around the world. And here is the 20-week cycle trough, again a very nice, neat nest of lows for the 20-week cycle trough that is expected to form in September. The big difference here is that, of course, we have a more bearish picture because of the fact that the analysis is generally more bearish, with the 54-month cycle pressing downwards. And here is that 54-month cycle trough. It's a bit of a staggered nest of lows, but it is pretty much over here in early next year, February or March perhaps of next year. And so the difference, as I mentioned, between the NASDAQ and the S&P 500 is the NASDAQ is more bearish, but we are looking at a similar structure in terms of us getting an M-shaped cycle into the 20-week cycle trough expected in September, you will notice that it is slightly more bearish in shape in the NASDAQ than it was in the S&P 500. And then, of course, we are going to get a much more bearish cycle to bring the price down into the 18-month or possibly 54-month cycle trough expected early next year. The important thing about considering this composite model line, and I often get questions emailed, and I do my best to answer all of those questions in the emails or in the comments, but it's worth repeating in these videos. The important thing about the composite model line is it shows us very clearly the expected structure of the market, by which I mean when the turning points are expected to occur. The composite model line is not as accurate in terms of price levels. The reason for that, in my opinion, is because the cycle amplitude, the strength of each one of the cycles, tends to vary much more than cycle wavelength does. That's been my experience with trading these markets. Wavelengths vary, of course. The principle of variation tells us that wavelengths are constantly varying, but amplitudes vary to a much greater degree. And as those amplitudes vary, so we will get different price levels achieved as the cycles influence price to reach their peaks or their troughs. But the important thing is that these signposts in terms of when we're expecting troughs to form, and to some extent when we're expecting peaks to form too, will tend to be a lot more reliable. So those are the things to really look out for, rather than actually measuring the price level. I know the temptation is, with this wonderfully confident dashed orange line, to measure the price level. In my experience, that's not really the best approach. The more important thing to do is to take a look at when those turns are expected. If the markets turn more bullish than expected, then of course all the price levels will shift, which is why we constantly monitor the shapes of these cycles, as I demonstrated last week and earlier, by taking a look at the intraday cycles and tracking the shapes of the cycles as they form in the markets. As soon as we see any indication that the market is not as bullish as we would have expected, or as bearish as we might have expected, then of course we will adjust our opinion in terms of price levels at which these turns will occur. Now let's take a look at gold, and it's been a little while since I spoke about gold. Gold has been a textbook case. It's been a wonderful example of Hurst cycles working in the gold market. As you might know, I prefer a peak analysis for gold, and let me just quickly explain why that is, because I know there are many people who are new to Hurst cycles who come along and watch these videos. So Hurst performed his research in terms of what influenced financial markets 50 years ago, and he studied US stocks, and he discovered that various cycles influence these markets, which are of course the cycles that we still speak about today 50 years later. But he defined various principles. I won't go into all of them here, but the important principle in this situation is the principle of synchronicity, which tells us that the cycles are synchronized at their troughs. And because he was studying stock markets, we've amended that principle ever so slightly to say that cycles are synchronized at their troughs in stock markets, because there is some fairly good evidence that in precious metal markets and in commodities, the cycles that influence those markets are in fact synchronized at their peaks as opposed to their troughs. So we're looking at exactly the same basic approach in terms of cycles influencing price action, but instead of the cycles being synchronized at their troughs and therefore plotting diamonds at the foot of the chart, we are considering cycles synchronized at their peaks and plotting triangles at the peak of the chart, or the top of the chart, to mark the positions of the peaks of those cycles. You will notice that this chart has two analyses on it. It has a trough-based analysis and it has a peak-based analysis. I speak about this every time we mention gold, so I'm not going to dwell on it too much, but the important thing is that they are in fact two separate analyses. The more reliable analysis, in my opinion, in gold is the peak-based analysis, and it's something that Hurst cycles analysts have discussed for many, many years. And it is in fact the reason that Sentient Trader is able to perform a peak-based analysis, because of my early work in analyzing gold together with John Eastreich, the late John Eastreich, who used to post under the name of Silent One. Very experienced Hurst cycles analyst. He did a lot of work with gold, and that is why Sentient Trader performs a peak analysis, because of his belief that the cycles are synchronized at their peaks. The important thing, of course, according to this analysis, is that we witnessed a very important peak over here. Where is that? In 2020, and that is a peak of 9-year magnitude. According to this analysis, I wouldn't take the 9 years too seriously. It was almost certainly a peak of 54-month magnitude, so a very important peak. And then we had another peak of 18-month magnitude over here. That was in early March, and so at this sort of time scale, we're looking at a 20-week cycle peak to form over here, probably in, where's that, August. And then, of course, a 40-week cycle peak is expected towards the end of the year, perhaps in December or something like that. The interesting thing about gold is that even though it is better described by a peak-based analysis, I often find a trough-based analysis working really well, which is why I tend to monitor both analyses on my chart. And at the moment, the trough-based analysis in gold is working really well, in my opinion. We have a 54-month cycle trough over here in March of 2020, just as we do in the stock markets. And of course, there is a direct correlation of some kind between stock markets and gold. There's a generally held opinion that gold moves in the opposite direction to stock markets, but of course that's not true. It's a gross generalization. But there is a direct relationship because of the fact that gold and stock markets are perhaps two of the biggest stores of value, if you like. Stock markets, of course, are a huge store of value, and gold is also considered a huge store of value. And so they tend to move with a great deal in common. And that's been really interesting to watch. Recently, we have the 54-month cycle trough in March of 2020. We have an 18-month cycle trough. In my opinion, you can see I have actually had to influence the analysis slightly here. I positioned that 18-month cycle trough over here in August. Slightly questionable position. It's a bit of a spike low, which is a little bit unusual for an 18-month cycle trough, but nevertheless, we then get a 40-week cycle trough over here in May, at the same time that the stock markets experienced a 40-week cycle trough. So it's been really interesting to track these analyses. The thing that I really love about this analysis, and I showed it in the previous update that I made about gold, I believe, or perhaps the one before that, but it's the way in which the composite model line so accurately describes the price action. And there's actually a little surprise in terms of this composite model line, because a composite model line can be based upon the peak analysis or the trough analysis, or a combination of both of them. And this is a composite model line based on both the peak and the trough analysis. And it really matches price action very well. There are, of course, a few discrepancies, such as over there and over there. You can see where price has moved fairly far away from the composite model line, but it's an extraordinarily accurate match of price. And the interesting thing is that if we base the composite model line only on the peak analysis, so we deselect the troughs, we get an even more accurate match of price action, in my opinion, except for various periods of time where you can see that the structure of the market as defined by the composite model line is fairly accurate, but the price levels reached are not. So in my opinion, that's an indication of a time where perhaps the trough-based analysis would have been the more accurate analysis to track. I find that really interesting, and you will notice that we have a discrepancy with the peak-based composite model line in terms of what is happening to price action at the moment, which might be an indication that we need to pay more attention to the trough analysis. So let's zoom in and do that. So here you can see in a little more detail the discrepancy that has occurred recently between the peak-based composite model line and the price action. So again, we have fairly well matching structure in terms of when there's a peak in the composite model line, there is also a peak in price. when there's a peak in the composite model line, was also a peak in price, as you can see over there. So we have a fairly good match for structure, but the price levels aren't matching very well. Why is that? Well, there are various possibilities. One is simply that after the formation of a fairly big magnitude peak, and the same thing happens when a trough forms, quite often it takes a little while for people to realize that the cycles have turned, if you like, and so you will often get a fairly neutral shaped cycle as the first cycle that forms following a big magnitude peak or big magnitude trough. So maybe that is all that happened here. But the other possibility, of course, is that we are beginning to see a bit of a shift towards the trough-based analysis. So if we add the troughs into the composite model line, you can see that recently, certainly, we've had a fairly accurate description of price action on the basis of the combination of both the peak analysis and the trough analysis. And there again, you can still see a little more bullish distortion in price relative to the composite model line. And you must realize when we're looking in the past, we are not projecting forward, we're actually using the information contained in the analysis. And so that composite model line represents the influence of these cycles as found in the analysis. Quite an important point to make about the composite model line in the past. So what are we expecting in terms of gold? Well, again, here is the peak that we are expecting for the 20-week cycle, which is expected sometime in August. There it is in the composite model line. We have some troughs to look forward to. In about the third week of June, we've got a 40-day cycle trough and then an 80-day cycle trough towards the end of July. The composite model line is not giving us very much information in terms of which is going to be the lower trough. It looks as if though it's all just smoothing out, and that is because of the combination of the peak and the trough analysis. But those are the sign points that we need to watch for, and as I have mentioned in the discussion to do with the NASDAQ and the S&P 500, we're going to monitor carefully as the cycle shapes unfold to monitor the state of the market. If we zoom all the way back out again, of course, the message for gold is fairly clear. It is still looking bearish into this 18-month cycle trough expected early next year. But here's the interesting thing. This constant interplay between the peak analysis and the trough analysis could change that, which is why we need to keep a close eye on the cycle shapes as they unfold. And again, more important than the actual price levels indicated by the composite model line are the actual structure in terms of the timing. So we are certainly expecting an 18-month cycle trough expected early next year, but we are also expecting a 40-week cycle peak expected towards the end of the year. So as price action unfolds, we're going to track its progress towards each one of these peaks and also each one of these troughs to understand how the balance of the bulls and the bears is playing out. As a matter of interest, it is often a little dangerous when you get a fairly big magnitude peak, such as this 40-week peak over here, which precedes an equally big or slightly bigger magnitude trough, such as we see over here, because that does warn of exactly what we see in the composite model line, which is a fairly swift move down. So we need to be careful of that as we approach the end of the year. Certainly something to look out for. Now let's take a quick look at Bitcoin, and this is the analysis I've been looking at and considering in Bitcoin for some time. In fact, in an update that I posted, I think it was in March, a market update for Bitcoin, I mentioned that we were expecting Bitcoin to reach up into a 20-week cycle peak. We were expecting it early April. I think it occurred in the last few days of March, but there is that peak, after which we were expecting price to move down, and then it is expected to bounce back up again into the next peak of the 40-week cycle, which we are expecting in about July. And so nothing has changed really. All that is left to say really about Bitcoin is that, again, the peak analysis seems to be a better analysis than the trough analysis. Although in the trough analysis we are witnessing some cycles that match very closely the cycles that Hurst discovered 50 years ago. Here is the recent 40-week cycle at 296 days. Average length that Hurst discovered 50 years ago was 272 days. So about a 24-day difference, less than 10% at any rate, not a very big variation. And the peak analysis, you can see, is even more accurately beating to the rhythm that Hurst discovered 50 years ago. I find that extraordinary, which is why I keep repeating it. You can see 138 days elapsed in this 20-week cycle in the peak analysis. From the peak in November to the peak at the end of March, 138 days. The average length of the 20-week cycle that Hurst discovered so many years ago was 136 days. And so there was only a 2-day discrepancy. Sometimes I imagine Hurst looking forward 50 years and seeing the same cycles that he discovered all that time ago beating in the markets. It's a really extraordinary thing. So what are the implications of this analysis? Well, let's display the composite model line, which again in Bitcoin is tracking price action really well and really accurately. Again, we should concentrate more on the structure than the actual price levels, but the meaning is very obvious. Having formed a 40-week cycle trough, which seems likely, although we'll zoom in a moment and consider that in a little more detail, because it's not a very clearly defined trough, but we're of course expecting price to bounce up into this 40-week cycle trough, which we've been expecting for many months. And here it is. It's still expected in about July. When that peak forms, price should turn down into a 20-week cycle trough. And then we are looking at price moving up into the next 18-month cycle peak. At this point, you might be asking, but what about this 18-month cycle trough over here? So here is the really interesting thing. This is a composite model line based only on the peak analysis, because in my opinion, the peak analysis is a much more accurate analysis than the trough analysis. However, we see a nest of lows for the 20-week cycle trough over here, where the composite model line is indicating that a trough should form, but the composite model line is based only on the peak analysis. Isn't that interesting? So for the near future, by the near future I mean the next 6 months, so perhaps middle term future for many of us, the peak-based analysis is giving a fairly good indication of what we are expecting. But we need to bear in mind that this instrument might go through periods of time when the trough-based analysis is more accurate or better than the peak-based analysis. So let's take a look at the composite model line that combines both of these analyses. And there it is. You can see that it presents the same basic information in terms of price rising up to this peak, the 40-week cycle peak expected in July. And then it is expecting a move down into the 20-week cycle trough in October. But then the move up to this 18-month cycle peak, you can see, is interrupted by the fact that we are expecting an 18-month cycle trough to form over here in early 2023. What we're going to have to ask ourselves as we approach that time is which analysis or which combination of cycles is influencing this market more accurately. Is it the peak synchronized analysis or the trough synchronized analysis? And that's why it can be a little dangerous to look too far into the future on the basis of a Hurst cycles analysis, because again we need to be monitoring each of these cycle shapes as they unfold to track the state of the market. But let's zoom in, as I promised we would, and consider the formation of this 40-week cycle trough. Why did I say that this is not really a very clear trough that has formed? Let me remove that composite model line. The reason is because when a market is influenced by cycles that are synchronized at their troughs, you tend to find fairly sharp, isolated cycle troughs. The price action that we've witnessed over the past almost a month now is certainly not a sharp, isolated trough. Price has been really struggling to break up out of the 40-week cycle trough, which is why you can see I had to influence this analysis to position the 40-week cycle trough over there. In my opinion, it is likely the 40-week cycle trough has formed, but it is quite possible that this sort of going nowhere price action, this wedge that is forming over here, it's quite possible that we're going to see a jump lower in price, and a 40-week cycle trough might still lie ahead of us. The important thing, in my opinion, is to focus on the peak analysis, and we are still expecting this peak to form in Bitcoin in about July of this year. I do hope that you found this market update useful and interesting. If you have any questions, please put them in the comments below the video. I look forward to hearing from you.